One question we get often is, when will the Bank of Canada or the Federal Reserve begin cutting policy rates? The most honest way to answer this when I'm asked is, I don't know, but the truth is neither do the pundits that we often see on TV or even the central banks themselves. But what do we know? We've been told many times that central banks have planned to take a data-dependent approach to policy normalization. And if we look at the data, we can see pretty clearly that one of these things is not like the other. This chart shows the unemployment rate, inflation rate, and the Fed's policy rate before, during, and after the pandemic shock. The one thing that should jump out is the normalization in both the jobless rate and the inflation rate, and the still elevated and restrictive level of policy rates. While this may seem like an overly simplistic approach, it highlights the need to normalize rates sooner rather than later. The Fed and other central banks don't want to stay excessively restrictive for too long. Staying overly tight runs the risk of inflicting unnecessary pain on households and businesses. Most countries spent decades below their inflation targets, so perhaps this is the one chance to stick the landing. We also think the US economy is in the midst of a productivity growth cycle, not unlike the one we witnessed in the mid to late 1990s. This, coupled with the expected normalization in policy, are some of the reasons we are optimistic and now outright overweight US equities in the portfolios we manage for Canadian investors. For more of our thoughts, check out our Q1 Thought Leadership paper, 11 Questions for 2024, on fidelity.ca.